Fabio, what do you expect in redemptions this year? How ugly will it be?
You know, the typical December redemptions run around 3.5% of assets. There's no reason not to expect it to be two different things, not just repositioning and doubling that to taking it to maybe a 5 or 6% of assets, but you can also expect to see, I think, a greater level of disappointment. And I think October arrived at the wrong time for the people that have, as many people may know, a hedge fund, unlike a mutual fund, you can't just put in a redemption on any given day. You have to give notice 45 days or 60 days. October happened at the wrong time for redemptions, and it happened in the wrong way. You can underperform, that's one thing, but when you're in the portfolio to do something specific and you fail, if you're a convertible bond fund and convertible is supposed to do well when volatility goes up because they've got an embedded option is the story. Market neutral, we hedge out all the risk factors is the story. They're down. Convertibles had a horrific month. Market neutral was solidly down. People aren't going to question, gee, they're a little under the S&P, should we be in this, should we be in that, but rather should we be in the sector, should we be in the strategy itself. And macro put in particularly the systematic macro, the machines that everyone was talking 8 months ago about being so smart, got slaughtered. And I do think that all of that is going to weigh immensely around the table in October.
So, Rick, this was kind of something I was wondering over the last couple of weeks, like the decline in oil that was so fast and so furious. Even the decline in tech felt so fast, so furious. Do you feel like any part of that was like pre-redemption selling? Like, let's just get out while we can, let's sell the winners while we can, just in case we need to have big redemptions?
I think tech, yes. I don't think so in oil. I think oil came, this 20+% drop kind of came out of left field for a lot of people. We had warned clients when oil was in the 70s, you weren't going to see $80, $90, and $100 oil. And it's only a month ago that you had half the analysts on the street talking about how we were going to see $100 oil fairly quickly. I think there was a significant fundamental shift in oil and its use relative with fossil fuels and alternative investments and what's coming forward. And this is probably the first leg of what's coming in the future, which means long term, I suspect oil's going well lower. And therefore, what we saw probably is not so much hedge funds dumping out to protect profits, but more so because losses were mounting and it was kind of like, let's run for the hills.
Yeah.
I might take the other side of that, at least in terms of the 20% decline. We had the Trump tweet comes out.
Sure.
The Trump tweet comes out calling it for a decline. Then he surprised people by doing lesser sanctions on Iran, which took some of the heat off of, which infuriated the Saudis and also increased that. And last but not least, an incredibly important spread to look at from the hedge fund perspective is the greatest trade that's been going on for months in the energy space: long oil, short natural gas,
which got totally blown out.
And natty gas went up like 47%. It might be a cold few days, but that's not what's causing that kind of a thing. That's only caused by an insane amount of short covering. It's the only thing that'll drive that up. And simultaneously, you see oil tanking. So I think that there is a whole, Tesla moving away from oil, but this kind of a violent movement usually has real money flow on the wrong side behind that. I think that was the case for a good part of it. Not impinging on your central thesis.